Welcome to The Explainer. So today, we're unpacking a really fascinating and deeply entrenched paradox in our global economy. Just imagine, if you will, that the international financial system is kind of like a massive high-stakes casino. But in this particular casino, one player effectively owns all the chips, they set all the rules, and they literally never have to worry about going bust. That player? The United States. And today, we're looking at exactly how that happened by exploring the origins of exorbitant privilege. This brings us to the core mystery of our explainer. How exactly does the US borrow money at such incredibly low rates year after year, while continuously running these massive trade and fiscal deficits? I mean, if literally any other nation tried pulling this off, their currency would probably collapse and inflation would just skyrocket. Yet the US enjoys these totally unique financial advantages and this unchecked borrowing power that absolutely no other country on Earth can claim. So why is that? Okay, let's dive into this. The answer lies in a concept known as exorbitant privilege. This refers to the unique economic benefits the US gets simply because the dollar acts as the world's primary international reserve currency. It's basically the massive advantage of being the global supplier of safe assets. Essentially, because everyone everywhere needs dollars to do global business, the US gets to play by a completely different set of economic rules. Which brings us to Section 1, Birth of a Privilege, tracing the anchor of global trade. So how did the dollar become the undisputed king of global finance? Well, this dominance definitely wasn't built overnight. To truly grasp it, we need to trace the historical journey and uncover the birth of this unique global financial power. Let's move to history and see how this builds, because reserve currencies actually shift over time. In the 17th and early 18th centuries, the Dutch Republic held this privilege. By the 19th century, it was the United Kingdom. Prior to World War I, the British pound was the world's go-to reserve currency, and British debt accounted for more than half of all traded securities. But, the total devastation of two world wars really shifted the balance of power. And that lands us squarely in 1944 at the Bretton Woods Agreement. Here, 44 allied nations established a brand new system, where the US dollar was officially tied to gold at $35 an ounce, and all other major currencies were then pegged to the dollar. America, which was holding most of the world's gold at the time, officially anchored the post-war global trade system. All right, Section 2, the French gold pushback, resisting the asymmetric financial system. Now, this Bretton Woods system, it wasn't universally loved. By the 1960s, some serious resistance started bubbling up, particularly from across the Atlantic. In fact, it was the French finance minister and future president, Valéry Giscard d'Estaing, who actually coined the term exorbitant privilege to describe what he saw as a deeply, deeply unfair arrangement. This quote from economist Barry Eichengreen perfectly captures the frustration of that era. He notes it cost only a few cents to produce a $100 bill, but other countries had to pony up $100 of actual goods to obtain one. The rest of the world felt like they were caught in this totally asymmetric financial system. They felt they were essentially subsidizing American living standards and the massive expansion of American multinationals. Think about it. The US could just run the printing presses for literal pennies, while European nations had to trade real manufactured goods and services just to get their hands on those same exact greenbacks. And this resentment didn't just stay politely tucked away in diplomatic memos. It led to some highly cinematic moments in economic history. In February 1965, French President Charles de Gaulle decided he had absolutely had enough. He literally sent the French Navy across the Atlantic Ocean to physically exchange France's paper dollar reserves for actual American gold bullion at the official exchange rate. And soon, other countries began to follow suit. I mean, imagine a foreign military showing up to your central bank demanding physical gold today. It was wild, and it rapidly began to drain and shrink the U.S. gold stockpile. Moving on to Section 3, the Triffin Dilemma, a structural flaw in the system. Because this gold drain wasn't just driven by French spite, right? It was actually a symptom of a much deeper macroeconomic paradox identified by the economist Robert Triffin. Let's bust the jargon here and break down this Triffin Dilemma. The U.S. was basically trapped in an impossible choice between two totally conflicting goals. On one hand, to keep global trade flowing smoothly, the U.S. had to supply the world with constant dollar liquidity, which meant they had to run perpetual trade deficits. But on the other hand, the more dollars that flooded the globe, the more the currency became overvalued relative to the finite physical U.S. gold reserves that were supposed to be backing it. You just can't supply infinite paper money backed by finite metal without investors eventually calling your bluff. And sure enough, the bluff was called. The dramatic climax to this dilemma happened on August 15, 1971. President Richard Nixon, watching America's gold reserves just rapidly disappear, completely severed the dollar's tie to gold. This became known as the Nixon shock. Now, it was initially meant to be a temporary fix, but it permanently turned the US dollar into a floating fiat currency. From that day on, the dollar wasn't backed by shiny metal sitting in a vault. It was backed purely by global trust in the United States government. Which brings us to Section 4, the dollar network effect. Why the dominance actually grew. Now, what's really interesting about this next part is you might assume that dropping the gold standard would completely destroy the dollar's credibility and end its global reign, right? But paradoxically, unchaining the dollar from gold actually made it stronger and way more dominant. The scale of the dollar today is absolutely massive. Even without gold, the US dollar comprises a staggering 58% of central bank reserves held outside the United States. Why? Because by 1971, the global economy had already crossed a point of no return. The world was so deeply structurally dependent on the dollar that there simply was no viable alternative ready to take its place. And that dependence goes way beyond just central banks. Roughly 90% of all global foreign exchange transactions involve the US dollar. To put that into perspective, it acts like the globe's default operating system. It's a massive network effect, honestly very similar to a dominant social media platform. Everyone uses the dollar because everyone else is using the dollar. That makes it the most logical, liquid, and cost-effective currency to use for trade, whether you're sitting in South Korea, Brazil, or Germany. So the crucial point here is understanding what this ongoing modern privilege actually looks like for the US today. It translates to incredible structural advantages. We're talking lower borrowing costs and the capacity to run massive trade deficits without facing a balance of payments crisis. It generates seigniorage revenue, which is essentially the profit made simply by printing money. Crucially, it gives the US unmatched monetary policy autonomy. And sitting right at the center of all this is the $25 trillion plus US Treasury market, which acts as the ultimate safe asset. In times of global panic, the world doesn't sell dollars, they rush to buy them. And that leads into Section 5, weaponizing exorbitant privilege, geopolitics, and financial choke points. Because this financial architecture isn't just about economics, it naturally spills over into geopolitics. We have to impartially look at how this setup is utilized as a tool of foreign policy, allowing power to be projected globally without firing a single military shot. The mechanics of extraterritorial sanctions are actually quite straightforward. Step 1, because the dollar is the global standard, most international transactions eventually have to route through corresponding banking accounts. Step 2, these payments almost always create a bottleneck at just a handful of major banks located in New York. And Step 3, U.S. authorities can effectively exclude targeted foreign actors from these specific nodes. Because of the heavy reliance on dollar clearing and SWIFT messaging, even third-party firms completely outside the U.S. face severe penalties if they deal with sanctioned entities. It creates these highly effective financial choke points. And this brilliantly illustrates a rising tension in global finance. You see, utilizing this exclusionary power naturally incentivizes peer nations to build alternative, de-dollarized financial infrastructure. Europe, for example, attempted to create the Instex payment channel to bypass sanctions for Iran trade. China has been developing SIPs as a potential substitute for SWIFT. And we're seeing the rise of Asian Kung Fu bonds, which are actually dollar-denominated bonds issued by Chinese institutions. That shows both a reliance on the dollar, but also a clear attempt to create new financing channels. Basically, overusing the financial weapon encourages the exact diversification that U.S. policymakers generally want to prevent. Which brings us to the very real domestic stakes. If exorbitant privilege is eventually lost and the global economic order splinters into competing multipolar financial blocs, the risks for the U.S. are stark. Without this structural advantage, the U.S. would face a sudden loss of its deficit financing capabilities. This means sharply higher interest rates across the board, vastly increased costs for government borrowing, and a depreciating dollar that would likely fuel severe inflation at home. We're talking about massive spikes in everyday borrowing, from government debt all the way down to your personal mortgage rates. The entire American economic model relies heavily on this privilege enduring. So we end our explainer with this thought. A system born from 17th century Dutch merchants, solidified by the British, anchored at Bretton Woods, and accidentally hypercharged by the Nixon shock, now faces a rapidly changing multipolar world. The global financial web is woven tightly with dollar threads, and untangling it would be painful for everyone involved. But as alternative networks slowly grow, we really have to ask, can the exorbitant privilege survive indefinitely, or are we quietly witnessing the slow transition of global monetary power? It's a question that will absolutely define the economic reality of the 21st century. Thanks for joining me on this deep dive, and keep questioning the systems that run our world.